News sources out this week saying Sycamore Partners, that's private equity, is looking at Walgreens Boots. Let's take a look at the stock as what it's done. And as you can see, this last 5 years in Walgreens Boots, it has been a terrible stock for investors to own. Sycamore is trying to buy this on the cheap. Let's go through the numbers to figure out what they're trying to buy and how they think they're going to make money. So let's look at the numbers as to why Walgreens Boots is struggling on the equity side. Right here, you've got a net debt of about $33 billion. As always, we compare this down to EBITDA. And this company is levered as much as 9x. Compare that to high leverage is 4 or greater, right? So they've got a ton of debt. And that debt is being refinanced at pretty high rates, 8.5% on their last piece. And when you look down here at the net income line after they paid their debt, there's not much left. Their net income margin are just 1%. And after you pay the CapEx bill, they are not making any free cash flow at all. These are the problems, and this is why the equity has gone from $60 at its high to $9 recently. Let's take a look at what Sycamore sees as to why they want to buy this company. So if I'm Sycamore, here's the first thing I'm in love with: $149 billion in revenue. Walgreens sells a lot of products, right? They don't sell it for much margin, but if you can change that, there's a lot of cash that flows to the bottom line. Imagine a Walgreens where they move net income margins from 1% to just 3%, right? They do that by selling less goods that aren't making them any money and maybe by refinancing some of that debt. If they do that, it is very possible to see free cash flow, net income numbers in the neighborhood of $5 billion. And free cash flow in the neighborhood of $4 billion, right? Now here's the good news for Sycamore. Look at how low this market cap is right here, right? Let's assume they pay just $10 billion for the entire equity of this company and then assume this debt and then refinance it essentially, right? If you're making $5 billion in net income, you can pay the price you paid for this company back in just 2 short years. So if you hold this company for, call it 5 years to make all of these changes, essentially, 5 times 5, that's $25 billion that you'll make, essentially. You have paid $10 billion, right? Maybe use the other 15 to pay down some debt, and then you push this thing back to the public markets without so much debt, which they'll be willing to receive. And we think that they could do this in aggregate and probably push it back out to the world at about $50 billion minus about 20 in debt, or $30 billion in net. You paid $10 billion for the company. So Sycamore sees at least a 3-bagger here. In possibility, it could be even greater if they could push net income margins even higher than 3%, or other things go right for Walgreens in the future, essentially. So all of these things lead Sycamore to walking in, buying this thing on the cheap, making a bunch of money, then flipping it back to the public markets, and they can make a really good return in a short time by buying this company. Thanks to everybody who's watching. You can see we got a new setup behind us. Everything's getting better here at River One. We love making these things for you. We get a lot of great feedback, so please keep it coming. We appreciate it. You want to see anything? Just let us know.